Hi, everyone, and welcome to Macro and Global Liquidity Analysis, Gold, Silver, and Bitcoin monthly update for May 2025. We're putting this presentation together for our value clients of the Ainslie Group, including Ainslie Bullion, Ainslie Crypto, Ainslie Wealth, and the Gold and Silver Standard. We're back again this month with our panel of experts. We've got Joe, our Research Analysis Manager, Paul, our Director and Chief Investment Officer. I want to start this off. I thought I'll start this slightly differently this month. I'm going to ask you, Joe, on a 1 to 10 scale, how bullish are you Bitcoin? I'm going to ask you the same question, Paul, for gold. Joe, where are you? Where are you on that scale?
I'm towards the upper end of that scale currently. I think there's a lot of things that are currently that are going on or planned or in the works that are causing me to think that the cycle is nowhere near over, or we've got a long way to run. So yeah, I'm keen to get into it and discuss why, and get you guys' thoughts on
Typical Joe won't give me a number. He doesn't want to lock himself in.
it.
Paul, how are you feeling on the gold? It's been a ride, all right.
Yeah, and look, it's holding strong. I probably think where we are in the market right now, probably a little more bullish on the alpha in Bitcoin. Certainly, gold is holding strong in the face of rising rates and all sorts of things. So it's they're both looking through the noise.
Okay, we got no strong numbers. I'm going to come out and say I think we're probably about a 8 to 10 on the Bitcoin bullishness right now, and probably similar number, probably 7 or 8 on the gold as well. So it's all looking pretty good. Look, I say that right before I put up the disclaimer slide. Before we begin with the analysis, just reminded everyone that everything we say and show in this presentation, even if it is a projection on a 10-point scale, is intended for general informational purposes, does not take into account your particular circumstances, objective, or situation, is not financial advice, and you should always do your own research and consider obtaining independent advice before making any investment decisions. So, look, we follow a consistent format each month, and that has been working in our favour. We'll do the same today. We tend to get a lot of positive feedback on the consistency, so we'll continue doing that. We're going to start off big picture, work our way through liquidity, macro, Bitcoin specifically, why we're even doing Bitcoin, gold and silver as the other part of that equation. We've got our trading plan that we've been following along, and oh boy, has it got some good results this month, but we'll save that to the end. Let's start where we usually do with the big overview of where we are in the cycle. Straight up, if we were to look at this, pulling it all together, you really can't get, this is probably why I was feeling so bullish at the start there, you really can't get a more bullish complete picture than seeing global liquidity increasing, the macro cycle early, which we'll talk about a little bit, and a strong bull market happening in Bitcoin. Joe, with you first up on that, you said it's all looking pretty good. If you take those elements, and I'll jump forward to specifically looking at the first two of those, which is the global macro cycle and the liquidity cycle. What's your interpretation of my bullishness there? Is it because early cycle means we've still got a long way to run? How do you view this chart? What are you thinking of the elements that make it up?
Just to be clear, I was bullish as well. I just didn't give you a number.
I
said the upper end.
I'm more bullish. I'm claiming it.
Honest, and I give definite numbers. We've part of our job in assessing liquidity is knowing exactly where we are now, and also forecasting, 2, 3, 4 months into the future, so we can get ahead of the curve in terms of what we think asset prices will do. Obviously, we've been through a choppy period there, and we've moved back into early cycle, with early cycle being defined as inflation somewhat subdued still, and growth starting to pick up. So that's, as we've discussed previously, that's very, very good for risk assets. Mid-cycle defined as rising growth and inflation, and I definitely think we're heading in that direction when you look at some of the policies, particularly within the US and China, that are starting to come to fruition and will be extrapolated through the next 6 to 12 months. So I think we're in my bullishness from gold, Bitcoin and gold specifically, come from knowing that the money printer is going to go brr, and that's going to drive inflation and growth.
The next part of this is Bitcoin, and we'll dig into that later, why specifically Bitcoin. We talk about that each month. But Paul, when you look at this chart, some people have been calling for a top. pretty consistently through this move. To be fair, we were cautious over the last couple of months, thinking that we wouldn't break to new all-time highs in this move, because remembering, if you look back to the red, several weeks ago, it was looking pretty dire, and we didn't think we'd get a V-shaped recovery that really shot straight back up there. We thought it'd take a bit longer. Do you think people are justified here in being a bit concerned that it's just gotten too far ahead of itself, or is there, from your big picture overview, is there a broader story at play here that could see it actually continue beyond here?
Yeah, I think, to Joey's point, the beauty of that framework is a lot of the noise that caused that pullback, and likewise in risk assets across the board, and that most hated market, bull market narrative is all the recession fears and that sort of thing. And we're just not there in the cycle. Okay. So that's why we're so, yes, we've chopped and changed between early and mid because of that, I think, lag of the inflation piece. But, we have a chart, and I think you're going to show it today, Chris, of just the sensitivity to liquidity on various assets. Bitcoin has a historically sort of 9x multiple on a 10% move in liquidity. We've seen the pullback, which was pretty much flagged late last year, and we were saying Q1 will have a pullback, and we saw that. When you're talking about an asset with the alpha that Bitcoin has, and you look at that historic correlation with liquidity, and you see where we are in the liquidity cycle, this is not extraordinary at all. So we've had a bit of the pullback that we ordinarily have at this part of the cycle, and I think I'm not saying goes up from here. It'll have its usual retracements, but I think we're still very firmly in mid of that cycle. We're not late.
And I think we can talk a little bit about what is driving some of that concern and why we're looking through it a little bit by digging into the global liquidity cycle. It is the cornerstone, probably the most important part of what we do. That's why it's sort of the first thing on that initial chart, highlighting how we're thinking. When you look at the long-term cycles, going back to the 70s, we've talked about this many, many times, based on the work of cross-border capital. It's so consistent. You just see periods where more money is flowing into the system and periods where it's not flowing as fast anymore, or even slowing, and they're trying to pull money back out of the system. It results in very consistent peaks and troughs that lead to either booms or busts. So it's the driver of that cycle. We've talked about, and you can certainly look this up. You can go follow it on my X account at Tipper Analytics if you want to look at it there, or we regularly post this on ainslie.com.au as well. But the details of some of those crises and the corresponding booms, we haven't seen that big crisis yet. And sure, there might be one brewing. Everyone seems to think it's around the corner, Joe. I'm going to flick to the next slide while I ask you a bit more about that, but this idea of where we are in the liquidity cycle, everyone seems to think that there's a big crisis coming, but I think our perspective is we don't disagree with that. It's just timing, and we don't think the timing's now. Can you talk us through the big crisis coming and why, from this chart, it's not tomorrow?
Well, I think it's, a lot of those people that are calling for crises all the time, generally, I think they get a lot more YouTube views and views on Twitter and whatnot. So when you're monetizing your account, it definitely pays to draw in more attention, generally speaking, like that. The thing that everyone sort of needs to understand, and I think more and more people are becoming aware of it, is in a debt-based fiat system where collateral is the underlying asset. Like, so you've got where collateral is what allows the expansion of credit. You can't have that collateral go down in value. Otherwise, you get deflationary shocks in the system, and then those deflationary shocks compound, and then you end up getting financial crisis like you've got in GFC. That's why you'll see, generally speaking, if there's any sort of issues in the bond market or there's any issues in the banking sector, for example, the Fed or the Treasury respond to those very quickly because they can quickly get out of hand and they create contagion. So that's why, generally speaking, when you have a market crash or a deflationary event, it's usually somewhat engineered. Like it's done on purpose. Otherwise, for the majority of the time, it's up and to the right. You need liquidity expansion to keep the collateral values up and the economy ticking along.
Paul, I want to ask you to dig in a little bit more on Joe's point there about the engineered nature of this. If you look at this chart, which is again going back over about 15 years, it's up and to the right, undeniably. But those periods where it's pulled back, which is what Joe's referring to there as effectively engineered, why do they have to do that?
It's when things get overheated. So they fundamentally, this is all inflationary, and if that inflation, we can discuss at length the two different types of inflation. But if inflation generally gets overheated, and they just have to tighten it, or you get the unintended consequences play out, and then that causes a market event. But inevitably and somewhat cyclically, it just gets too much, and they have to tighten, or if they, the proverbial they, aren't tightening, the market is doing it. So and again, as we say with this chart, so often people keep talking about central banks, but they're really a relatively small component of it. There's a lot of it is that bond market as the collateral, as Joey was saying, for the system. And we've come out of a period of high volatility, and that reduces liquidity. That's not them doing anything; that is the market. And then we just get falling values through those increasing yields that we're seeing at the moment as well.
And looking at this chart, when you look back at sort of that 2020 period, you can see really just how much that took off. It really does explain why we've been through a choppy period recently. Like just looking at that chart, it's their attempt to pull it back. It's still sort of inching up, but when you had such a rapid takeoff, that's what you're talking about, isn't it? This concept of like they've got to rein it back in because they just got that was so much stimulus.
Yeah, and we're seeing particularly the major central banks still doing QT, so they're still offloading from their balance sheet, and you can argue they just went so incredibly hard during COVID. They know it's coming, like as Joey said. So I think they're just trying to reduce their balance sheets, ready for the inevitable buy up that they're going to have to do to try and contain yields as the last buyer standing.
And we can see that through some of this data because when you talk about them being somewhat restrained, that we don't have, even in this chart, which is looking across all of the, all the economies really of the world, whether they're expanding in green or also contracting liquidity in red. We've got flashes of green, but you wouldn't say it's a strong green picture. We certainly aren't in the strong red you see on the left, but we're not. It's not green everywhere. It's more the yellows. It's more the softer perspective, and probably more relevant is actually to zoom in and look at the majors. We haven't seen one that I think threw a lot of people off, and Joe, I'll ask you to talk about this. If you look at the recent green sort of block there at the end on the US Fed, that top line, people were getting really excited about all this liquidity coming back into the system, but a lot of that was just technical. It was just liquidity that sort of was going to happen anyway. It wasn't actually changes in policy to say, yeah, turn the printers on, let's really ramp this thing up. We're starting to see the slightest hint of that in this month. And probably more importantly, at the moment at least, China as well, that start of a hint of green. They're the two big players. Everywhere else, to Paul's point there's just making, it's like they're restraining themselves, they're holding back for as long as possible. How do you interpret what's on the screen there?
Well, if I had to, and I suppose if I had to choose two central banks that I wanted to be green, it would be the US and it'd be China, right? They're the largest economies in the world, and they're the ones with the most influence on global liquidity. That technical event that you were referring to with the US Federal Reserve there, that was actually a drawdown of the TGA before tax season. So I think the TGA, or the Treasury General Account, which is the government spending account, had about $600 or $700 billion in it. So that as that gets drawn down and spent into the economy, that's obviously very liquidity positive. It's not even necessarily a Federal Reserve's doing. It's just an account at the Federal Reserve that the government holds. With regards to the current little bit of green that we're seeing, we've got the debt ceiling approaching, and they're currently spending down what they have in the TGA from I think about 450 billion. So that may well turn green over the next couple of weeks while until that debt ceiling gets resolved, which will be liquidity positive. And in terms of China, we were discussing this before. If you look around at the world's bond markets around the world, particularly in UK, Japan, US, Australia, even in New Zealand, you've got substantially steepening yield curves. So the long end of the yield curves is losing value and yields are going up. When you look at China, for example, they've got historically low yields at the moment, and that's telling us that at the moment China is going through a deflationary bust, and at some point they're going to have to continue the stimulus that's sort of been stop-start recently.
And that's really interesting as well, to remind people that the world is not just one place, the same as the world is not just the US. There's a lot going on in different jurisdictions that are impacted differently by global flows of money. So it is a complicated picture from that regard, because China's green does, in this case, represent something different to the US green, and that might not be, you can't interpret them equally. Like overall, you can interpret the output of that equally with more liquidity in the system, but the drivers of that and the reason, or how much they're forced to put more liquidity in the system, is very different there. Because China, you could argue, is effectively in a situation where they have to do it, probably urgently. The US probably still has a little bit more control over the levers.
Yeah, and also like on that China picture, we've been watching currency exchange rates and that, and we've obviously seen a large devaluation of the dollar against other major currencies like the euro and the pound and the Japanese yen. Whereas you look at China's actually been strengthening against the US dollar as well. Like obviously that's a peg currency, but it's certainly trading more at the bottom of the range, which gives them a little bit of leeway to stimulate if they need to devalue further.
And you can see that stop start that we've been, we get excited, then they tighten, they get excited, then they tighten. So we're going green, red, green, red, green, red. I think and that's reflective of them being in probably the most pain as an economy. If you look at the G7, the average growth rate's, around 1%. So it's anemic, but it's okay. So they can still keep tightening and try and get everything ready for when this inevitably turns. So China is so big and caught between this, protecting the yuan and trying to get some growth. It's a very choppy picture.
I think that's an excellent explanation when you look at what you can clearly see there. It makes so much sense. And it also makes sense to me why people have, not all people, but a number of people have been misreading what's going on with liquidity, because they haven't understood that subtlety. They're just looking at the raw numbers. Because speaking of the raw numbers, if you look at this, it's pointing down, right? Like, so it's not probably surprising to me that we're getting a lot of top callers starting to, thump their chests on this and say, well, we're probably near the end because the liquidity started to turn down at that weekly level. It's more complicated than that, though, as you were just pointing out, Paul. When you think about what's actually going on here, there's a number of factors that go into why this is pulling back. We're probably less concerned about this here than we might have been otherwise. Do you want to give us a bit of an overview of the view that we're sort of taking on this current pullback in liquidity?
Yeah, look, it's multifaceted. So you saw, some pretty major central banks are still tightening, but again, I take you back to that other chart where the black part of that is not massive. We've had bond yields keep rising, and it's certainly at the longer end, and that's reducing the value. We've had a fair bit of volatility, albeit that's improving now with the bond market. So that collateral pool has certainly been under pressure. The US dollar looked like it had bottomed and was starting to strengthen. Arguably, that's turning around now. So they're bigger factors than what those central banks are doing in the market. So it's definitely weighing in on that in the nominal terms. But if we go back to the index, which looks at the quantum, the rate of change, and the direction, then we're still in an expansionary regime. And I remind you of the big numbers on the left-hand axis there. We're still talking $176 trillion. So we're still it's still up and to the right generally.
And such a good point, because when you look at that chart in its entirety, you're going, well, that's a 12 months, right? Like that's a 12-month view. And we're certainly a lot higher than we were 12 months ago. So that money is still flowing and still coming in against that backdrop of not really having the central banks doing that much of the heavy lifting part of it. It's those other factors that have been doing more of it. So when they come in, well, where do we end up? We take that next step though to use that as a base, but then dig into some of those things that you were just talking about, Paul, with the deep dive on the global macro cycle. Joe, we start that by looking at growth. We tend to focus on the US for this one, just to give us a narrower subset of data to look at. You can also look at this growth data more generally across the world, but to really dig into consistent data, the US is a good place to start. We've got this, like how I was wording this when we updated the data at the start of the month is if that's all it's got, we're off into the races. How are you interpreting that there? Because there was so much concern, like it was doomsday like levels of concern earlier on the back of tariffs and what they were going to do. Yes, a lot of that changed, and a lot of that changed because the bond market, which we'll talk about shortly, but was having a tantrum. But that leading indicator would seem to suggest that this was very mild in terms of a pullback.
Yeah, it's funny how markets will price things based on narratives, right? And there's certainly a very strong narrative around tariffs and around business and economic expansion in general, and how businesses perceive the tariff situation at the time. It was probably fair that we did get quite a negative sentiment shock like we've seen. Now we're looking forward, and we're looking forward towards legislation, for example, like Trump's big beautiful tax bill, which is, I know we said this at the start of the year that Trump was very pro-business and it didn't work out the last couple of months, but when you're looking at the amount of money and stimulus and government grants, for example, in terms of setting up business and manufacturing or whatever within the US, I think there's a lot of certainty around that, and that sentiment is generally very good for driving economic growth and services. I think what we also need to remember is that the US, whilst Trump is focusing a significant amount of his time and energy on manufacturing, services within the US are still by far the largest part of that economy, and that's obviously why we've included services as part of this chart. Services are going to be driven by people having more money in their pocket. Like at the end of the day,
they didn't even dip into retraction there. Like they were still actually above the 50 line.
Absolutely. And, if all these tax cuts get passed, which you've got to assume that they are, no tax on tips, no tax on overtime, and people and the Jobs Act gets extended, which, there's a little bit of uncertainty initially around that, but it looks like there's no reason why it wouldn't pass. How do services not go higher in that environment as people have more money to spend? Of course, that leads into inflation, but that's a story for later on in the year, probably next year. But at this moment, we've got to play the cards in front of us.
And this is the key chart now, right? So Besant and even Musk have conceded the austerity piece just didn't work. Okay, so the big beautiful bill is really about driving growth so they can grow their way out of, ironically, an extra $4 trillion of debt that they're about to allow. So this will be the chart to watch, because this, again, we've seen that chop change between early and mid cycle. We're back in early cycle, which kind of makes sense. Growth is still, meek, and inflation is still under control. But you start throwing the sorts of stimulus that's in the big beautiful bill at this market, and you know where this ends, right? And it's a dual thing. It's going to increase growth and it's going to increase inflation. But you also know it's going to increase the debt pile that has to be not only, the big debt wall that's got to be serviced right now and over this year, a whole lot more, all issued at short end that they're going to have to, service again very quickly.
Yeah, it's important to remember that, as the fiscal deficit expands and there's more money in the economy, some of that money, yes, goes into the real economy and it has an impact on consumer inflation. But a lot of that money funnels its way back up to the wealthy, regardless if it starts with the lower class. And the wealthy put money back in assets, which is why you see rising asset prices in a expanding liquidity environment.
Yes, and I think the point that you made too, around the services here, just thinking through that aspect of it, is the manufacturing is what got a lot of attention. they weren't thinking about all those other factors that actually flow through. Because when you talk about services and breaking it down by effectively income levels, when you talk about lower class or whatever, however you think about it, that is going to be more reflected through the services. That chart is really showing that those people who are sitting in those services jobs haven't really had anything to worry about here.
No, and we haven't seen unemployment like we did say. Well, I did. I'll admit that I expected employment to tick up a little bit throughout the year, but it just hasn't happened. When you deficit spending at 6-7% GDP, whatever it ends up being, it's a transfer of cash from the public system to the private system to keep the economy afloat. The amount of money it's too much to have significant job losses in a service-based sector.
Whether that changes shortly with AI is another story. But also, to that point, that's why we're not trying to forward project beyond the period that matters for our investing here. Like there are lots of big changes coming, but pricing them in that far out is probably too premature. Following on from that concept, we had, Paul, I'll ask you about this. Joe talked about this last time, or I don't know if it was on this video. On one of our videos, we were talking about just how significant the concern was over the tariffs and what was going on in the market at that time. Like, it was almost doomsday. It was really not great. And to be fair, had there not been a big pivot away from 145% tariffs, who knows where we would have ended up. It was probably justified, the fear at that time. What blows me away is that right now we would be more on the risk on side of that chart after effectively a month in that data. That is just a extraordinarily rapid change in sentiment. Is it just that that's the age that we live in now? How do you think about that? Because usually these things take a while. We don't go from full negative to full positive that quick. It seems almost unprecedented, the rate of change of sentiment at the moment. Is it social media? What is it?
I think we're seeing some massive globally reaching decisions from the US administration that are going to just bring on that level of fear, right? So, and it just happened to coincide with a lag in liquidity that I think just exacerbated the problem in the short term. But again, the trick is to look through that and see those risk offs as a buying opportunity if your model says it shouldn't be there, or it should be there and it's only short term, which ours did. So I think in fairness, you can always say there's a narrative to meet the sorts of fundamentals that we follow. You don't know what the narrative's going to be, but you know something's going to be there. I think the magnitude of the fear around what the US was doing drove a lot of that, and we just went from this, all the calls for recession and everything to now people looking through that and just probably understanding a little bit too of what's coming. Is that we saw when it got to peak fear, the capitulation, the deferment, and so Trump is at the end of the day a markets man, and I think we'll see that they know that they have to keep accommodating to service all the debt that's coming due.
I wonder if the markets effectively had a inoculation to some of that through that period that we just went through, because I can't really even think of another example in market history of it being so volatile, like such a shift so quickly. I wonder, do you think that, Paul, that maybe going forward the market becomes less responsive? I mean, I don't know how to interpret it. It's really quite unprecedented.
No, nor did the market. I think we've probably learned. So that capitulation at the 11th hour when it looked like the bond market was going to blow up probably we didn't know until then, right? So we didn't know the level of his conviction to drive these things through regardless. And we probably got an insight then. So the market is probably more expectant that, as we keep going on, the math of the amount of liquidity that has to come this wall of debt that's coming will prevail. And so they just didn't know. It was a big shock. It was a groundbreaking event, if you call it an event, that people didn't know. We know now. So I think we're going to have a lot more looking through by the market and not getting so caught up on the latest tweet or whatever.
And we might have seen that recently with the 50%, because any other time, if you mentioned 50% tariffs on Europe, it would cause the same what we had with 145% tariffs on China. Now the markets went, we'll see. We'll see what actually happens. We'll see what is negotiated. So yeah, that may be a bit of that immunity starting to come through in the market. Joe, you said before you can see a future where inflation is starting to pick up on the back of this. It would be consistent with our cycles approach that later in the cycle we see higher inflation. Right now, if you're looking at our leading indicator, it's well below the 2%. The inflation, the official rate, is certainly heading down towards to meet that. Is that the bottom potentially for this cycle? Do we get the 0% that was hoped for, worried about, depending on which way you're looking at it? How do you see that?
I don't think you can get 0% unless you have a sustained deflationary shock, right? And to have a sustained deflationary shock means the markets have been in turmoil for a number of weeks. If we saw the bond market blow up and then the stock market to follow, depending on how risk assets actually behaved relative to each other, you give it 3, 4, 5 days and someone's stepping in to do something. That it's not going to be any sort of sustained deflationary shock unless the government, unless it's a policy, right? And I don't think we're at a point in the cycle where that needs to be a policy or they want that to be a policy, particularly with midterms coming up. Well, we're talking specifically US, but particularly with midterms coming up in the next 12 months. In terms of inflation, yes, I think it probably has bottomed. Now, when we say inflation's potentially ticking up as part of the business cycle, that doesn't necessarily mean that we're going to get what we see there on the left of the chart, COVID type inflation with supply shock as well. We may see it sort of tick up towards 3 to 4%, for example. And at the end of the day, that may be palatable for the government, and they may be happy with that if they've got 3 or 4% inflation, but they're running the economy hot at 5 or 6%. You do that for a few years, and then you start eating away at your debt to GDP ratio. So, higher inflation, higher growth are all synonymous with what we believe will be a mid and late cycle in the end of starting probably the start of next year and into next year, middle of next year. So to see inflation tick up, it wouldn't surprise me at all, particularly if it overlays, it goes over our leading indicator, picks up over the top of that purple line, which is official data.
I think part of that's hand in hand with this. We talk about the move from monetary policy dominance to fiscal policy dominance, and by definition, that fiscal response is inflationary. So we're at the point where if you just continue to run deficits year in, year out, and you continue to increase that debt pile. So the US is at 36 trillion. They're about to pass a bill to take that to 40. The just servicing the interest alone, let alone rolling it over, and just the flow on into the economy of fiscal dominance means I don't think we're going to see zero rates again outside of something quite extraordinary. So if you look at the rate of liquidity growth in the last 12 months is about 3.8%. I know that's whole of monetary inflation, but if you fundamentally, that's what inflation is. It's the same basket of goods with a whole lot more money in the system. And more particularly, we're getting this run now where the last 3 months is running at 8%. And only last month, what was it, 14, I think, or 12?
It was certainly into the double digits.
We've gone from 14 or 12 down to 8, and hence that nominal dip that you just showed. That's still a fundamental debasement of currency. That is fundamentally what inflation is all about. So I think we're at the point of no return where we're not going to see zero again.
I think it's important to differentiate the fact that this time is a little bit different in terms of that monetary inflation, because the money is actually being put in the consumer pocket, like in the lower to middle class consumer pocket with those tax cuts, and that's going to increase the velocity of money, and that's what will drive inflation. Whereas before we had an increase in the money supply via QE and embedded balance sheet, but that didn't increase the velocity of money. It simply found its way into asset prices directly. That's the difference.
Yep, absolutely.
Paul, you specifically mentioned that 36 trillion, which is up on the screen now in the overlay of the bond chart and the bond market. We'll dig into in a lot more detail in just one moment, but just focusing specifically on that debt, you can see the acceleration of the trend if you were to look at that, and this goes over 30 years. To push that up to where you're talking about 40 trillion, which is right at the top of that chart, we've gone vertical.
Yep.
Like it's
and
beyond, when you talk about beyond point of no return, like we're at the point of vertical.
Well, and you start to get, vertical, exponential, whatever. I just finished saying I don't see rates coming down too much. So you've got a whole lot more debt with a whole lot more cost of debt through the yields and rates. It's a snowball that just will continue. At some stage, just has to end in a disorderly fashion. And then you're getting into the likes of Ray Dalio's sort of end of empire sort of thesis. It's a pretty nasty combination of a lot of debt and increasing rates.
When you look at this chart, I deliberately leave the 30-year one in there. It's not that useful, but just to give you the bigger view that it's sort of followed a pattern, and it seems to have broken that pattern recently where it's heading up, whereas it was heading down, which also aligns with your point that you're making just then, Paul. But when you look back, I think it's dangerous for people to assume that the last 30 years is relevant here, because the line over the top of the debt didn't exist at this magnitude back then. The rules appear to be changing. When we zoom in and look at the last 5 years, Joe, there's many ways they can deal with this. We've talked about this for a long time. About one potential path was the bond market getting disorderly. Disorderly meant that it was breaking up those yields that you can see there, breaking up, breaking out to new highs when they want them to go down. That's the simplest explanation I can give for disorderly. The bond market is complicated. In simple terms, your interpretation of where we are now, what is this chart actually showing for people who find bonds all a little bit too complicated? What's going on here? Why is it something that requires probably a closer look?
So from a simplistic sort of, bonds are complicated, as you pointed out, but I think the way to look at this is each of those coloured lines represent a different duration of debt. So if you think about it as a 30-year mortgage, then it's comparable to a 30-year bond. For example, you pay the interest along the way, and then with the bond, you pay the principal and gets given back to you at the end of it. But think about that in terms of duration. As those lines go up, the interest on the new debt that's issued becomes more expensive. As you can see in 2020 and 2021, 1.5% interest rates, like that's how much when the government was asking for money, you would be paid as interest before the end of and then when you eventually got your bond back, you'd be paid the full amount back. As we've seen, as the interest rates go up, the value of the bonds in existence actually go down because you're getting less. The bonds that were issued previously are getting a lower interest rate, so they're valued less, if that makes sense. So what we're seeing at the moment is we're really in a period of uncertainty where they've just been chopping within a range, right? Or pretty much all durations. To your point, if that starts to get unruly and it picks up, you start to see those rates really start to rise and the value of the bonds go down, which is an important part of our collateral value, that's when a lot of havoc can be caused. And you generally see, like we saw in April last month, someone steps in and does something, whether it be the Treasury or the Fed, to either shore up the market or print money to buy bonds to stabilise it so that the collateral values don't come down and we don't have those deflationary shocks that we spoke about earlier in the piece.
And I argue that you don't want people to understand this, if you're the government, too closely. You want them to know they're getting their money. You don't want them to ever be concerned about the bond market, because from their perspective, the bond market is the safest market in the world. That's certainly the perception that's given. If you start to see it become unsafe, there's some big issues that creates because you can't issue that debt. We've seen maybe that part of the reason this is pushing up, these yields are pushing up, is because people are starting to question that, whether it's actually safe and looking for alternatives instead. It's certainly going to lead into our discussion on gold. that, do we really want to be holding debt?
Well, particularly foreigners, like foreign investors. So, when you've got your own bonds in your own native currency, which are also rising, remember it's all a relative game. So in the JGB 30-year, for example, was it 3.5%, 4% now? So all of a sudden you can get yield from your JGB, your Japanese bonds. So you repatriate that money out of the US and you take it into your country, which means that you're selling the US asset, which drives yields higher, right? So when that's done at scale, that obviously has quite a large impact on the value of the bonds in the US or any other country where capital's fleeing from, for example.
It's certainly complicated, and it's one that we need to continue to monitor because it does have that huge impact on liquidity, which flows through to everything else. The last one in this section that we look at is the dollar. And Paul, that it's testing that line that it's been sort of bouncing around from for a long time. If it breaks here, is there potential for it to go significantly lower, the US dollar? Could be good for us here. It could see some strength in the Aussie, maybe, you never quite know. But if that happens, that's generally considered liquidity positive, isn't it?
Absolutely. Of the whatever it is, $360 trillion of debt in the world, a lot of that is US dollar denominated. So as that US dollar weakens, then the balance sheets, it expands for the world effectively. So everything gets easier for those holders, and we get liquidity positive. Yeah, we were just in a meeting in our investment committee yesterday, looking at this chart. When you zoom out and you look at the period of the late 90s, all of a sudden this chop for the last 3 years looks fairly insignificant and quite high. And if you saw what I guess instigated that huge drop in the US dollar in those early 2000s, it was money leaving the US after a whole lot flowing in with the tech boom. We could well be in that situation where, for different reasons, there's a loss of faith in the US, and we're seeing that in yields. We're seeing that straight out in bond purchases data. We're seeing that play out in going into gold rather than to US treasuries. But then, if this breaks out, we're going to be very, very attuned to what's next, because it could fall if it repeats the early 2000s. And don't forget, it's only back in 21 we were down in the 80s. It's probably the thing to watch at the moment.
Yeah, absolutely. And it has such a huge impact because of the multiplier effect across all those things you discussed. Absolutely is the thing there's many things to watch, but it is one that probably has a more outsized influence on everything else than any other factor that we've discussed. We'll get into Bitcoin, we'll get into gold. We spent a lot of time really digging into the weeds a little bit this month on what's going on in the liquidity cycle and what's going on in the macro. So I'll go through some of this a little bit faster, because it's almost the effect of what we just discussed that we see flow through the prices. We, first of all, like to talk about why we focus on global liquidity and Bitcoin specifically. We know global liquidity is tied to world wealth. You can see it very clearly on that chart, that movements in one impact movements on the other. It's really important to understand that monetary inflation hedges, including gold and Bitcoin, are the only thing that really keeps up with liquidity, particularly if we're about to go vertical or exponential, or whatever you want to say. You're going to need to have those, because CPI, that dotted line at the bottom, is not keeping up at all. So you don't want to be relying on wages in that situation to keep up with that additional potentially 10% of liquidity that's coming purely from injections in the budget. Paul, you referenced this chart earlier where you said, we really do look at Bitcoin in this environment because of its sensitivity to that. So if you're expecting a 10%, say, jump in global liquidity, pure, or even just taking that US aspect where you talk about $4 trillion on $36 trillion existing sort of debt, it's a big number, big percentage of the existing debt that exists that's going to increase. If that flows through to be something roughly like 10% of global liquidity, you've got some numbers here that show it looks pretty good for both gold, but particularly Bitcoin.
Yeah, you can directly reconcile, the circa 40% jump we've just had in Bitcoin with that expansion of liquidity that we keep talking about. So, nothing comes close to it. We can talk about Ethereum, but that's more speculative than Bitcoin, arguably. So you'd expect it to have higher returns, but nothing comes close to these assets in terms of that multiplier effect on liquidity. Now, gold and silver are beautifully high as well. They're just more mature assets, so there's not as much adoption effect playing out in terms of that multiple. But between those three assets, you've got a very good means of not being on that dotted black line, the CPI treadmill, and getting into actually profiting from this perverse liquidity cycle that we're in.
Joe, our version of sort of looking at this to try and get more numbers on it, that's that sort of 3.8 we were talking about the 4% is where that line is showing of the rate of change growth of liquidity. When you look at Bitcoin on an exponential chart, you can see it's right back up at those highs. It's a little bit higher than that now, even from this chart when I produced sort of a day or so ago. But the breakout potential is certainly there. And the upper targets, well, we know with Bitcoin, you can't really predict it because it when it runs, it runs. We're potentially there. I just want you to have that chart in mind. We've also got our liquidity one, and we can talk about this, but I'm going to do it through a different chart. So if you look at this one, we've got that we were talking about the shorter term liquidity might be pulling back, but we want to reconcile that against that exponential chart we were just looking at, that logarithmic chart we're just looking at showing potential breakout. I just want to land on this one to ask you, if we think in terms of cycles, it has just gone straight up. If you combine that, what we know about the shorter term liquidity, the weekly liquidity sort of pulling back a little bit, what we've got there with the rate of change right at that breakout line, how do you think about that in terms of risk here? Because there are a number of people who are concerned that it's moved too far, too fast. I don't know. Just talk us through that, because historically it can have huge moves and then this will be nothing. But then if you've made a lot of money because you were in, even in this recent move, you got in the low 70s and you're now up over 100, you're 110. That's a lot of money. How do you think about that?
I think first of all, you need to remember that Bitcoin can go a lot higher and inversely a lot lower than people actually expect, which is what we've seen because it's a very sentiment-driven asset, right? It can overshoot and undershoot liquidity. In which case there's opportunity there. In terms of where we are now. Sorry, you're talking about. Sorry, what was the first part of your question?
Well, it was just saying for people, like, we can see there's signs. There's multiple signs there that would indicate we might have gone too far, right?
Yeah.
How do they navigate that?
Yeah, so I think it all comes back to risk adjusted, right? And at the end of the day, yes, we may have a pullback, a significant pullback of like maybe 10, 15%, if you want to call that significant. However, on a risk adjusted basis and how we look at global liquidity and where we perceive global liquidity to be going in the next, 2 to 3, 4 months, is it really worth maybe saving yourself a little bit of pain in the short term and missing out on all that potential upside in the long term? We've talked a little bit about policy and what we think the money supply and global liquidity is going to go over the next few months as the economy expands and legislation passes. I just think at this point in time, you stay in the market, you hope for a dip, you buy the dip, and then ride the upside. That's how you trade it.
And I'll dig into that a little bit more, because we know another red arrow will come. Another red arrow always comes. Every cycle, you have to expect. The main reason we put this chart in is so that we are reminding ourselves constantly it doesn't just go in one direction. The same when it's falling. We will get another green arrow. We will get another red arrow. We're at that timing band where you would expect another red arrow. And just briefly on this next chart, you can see there is clusters of positioning building up where it makes sense that it can go a bit lower. But I think, to your point, if you wanted to risk adjust it, you would have to be treating those dips as buying opportunities and really setting yourself up for higher, not trying to be a hero to short the top, and as a lot of traders do, they try and trade the downside. They try and short it or sell at the top that they're going to be able to buy lower. It could actually, both things could be true. It could dip down, hit some of these levels, and then shoot straight back up. It's very, very challenging if you're positioned against the fundamental trend.
Yeah, and if your fundamental view is that it's going to go up, and you're worried about a short-term pullback, like what are you actually worried about? Are you worried about going through that little bit of a pullback and feeling that pain for a short period of time? Like, I think as investors, you got to change your psychology and assume that you just need to ride it out, and that you're going to be able to buy during those dips. That's exactly how we look at it when we have a fundamental view that liquidity is going to continue rising. Back to the start where we're 8, 9, 10 out of 10 bullish.
I steals my numbers now. He wouldn't give
Yeah.
them
I'll use numbers now.
And
I don't see why you'd want to be out of the market.
And that chart you shared, probably 4 back, that had the projected liquidity. Like it's calling it's the cross-border capital one. Where it's got the expected trajectory. So before that, I think that one there. That's telling us that's the look through piece, right?
Yes.
And we're not just relying on someone's dotted line. We keep measuring it or putting it against the macroeconomic cycles, and we're early. We're not even mid. It's a high conviction play that will have dips that, as Joey said, are more buying opportunities rather than waiting for it, because you don't know if you're going to snag it or if it even happens, because fundamentally it's up and to the right. So that's really where we take the comfort that we don't get caught up in these dips. And it's healthy to have those red arrows. You don't want to just have it all green, because that's not going to end well.
And I have heard terms like lockout rallies mentioned that, we have problems here, that you can't get back in if it really decides it's going to move. Well, we need to touch on gold and silver. We won't linger here too long, but if we've got all-time highs happening, as we have seen in gold and silver as well, I mean, we can talk about really the nature of silver lagging, but just starting on gold here, how far into this side of it do you think we are? A lot of that could be argued to have been on the back of concerns over the US stuff that was going on that pushed it, but I don't know if that narrative holds up, because it was moving before a lot of that was happening, and it's continued to move after. So just give us the big picture view on gold right now.
Oh, look, I think we have to acknowledge gold might have come off its all-time high, but it's still very close to it. And that's, we just looked at, high yields. These are not environments where you would ordinarily see gold hitting all-time highs. And I think it's because the market is looking through. So they know gold wears two hats. It's beautifully correlated to that growth in liquidity that we saw in that bar chart earlier, but it also is the safe haven. And it's also becoming increasingly that non-counterparty risk sovereign asset that is not the US dollar based or US based bond market or even dollar. So it's got a number of tailwinds at the moment in the face of those higher yields. So and it's across a very broad spectrum as well. So we've got central banks buying up heavily. We've got Wall Street back in with ETFs, over the counter stuff, as Ainslie said. We've been smashed for weeks now of retail buyers, and we've also had the dynamic of the shift from or the big futures traders taking delivery of the physical, which in a highly leveraged system, when people start demanding the physical, then that just adds a whole lot of demand that wasn't factored in, because it just assumes leverage. So it's had a number of factors, and then none of them are going away at the moment. So whilst I start saying I think there's more alpha in Bitcoin, that's just that bar chart that just shows that it's a younger asset that has more potential for upside. But those that are more conservative you'll do very well out of gold as well, I think.
We've talked silver. I think everyone knows my opinion on that from if they've been watching these videos. Very bullish on this gold silver ratio. We've still been sitting up there around this 100. Recently, Drew, who's in our Melbourne office, was highlighting that it could stay there for longer than expected if we see a significant pullback of some description later in the cycle. It might keep it up there, but long term, the maths tells us it's going lower, right? Like if you're prepared to hold.
If you believe in nothing else in this world other than math and a reversion of the mean, we're at nosebleed heights in that ratio, and history tells us it reverts. The maths tells us it reverts. It'll be a timing thing. It's normally late cycle in terms of when that drop in the GSR happens, and so where you see silver dramatically outperforming gold. So we saw it late in that 2020 after gold had its big rally. If we're thinking this cycle tops next year, then you would expect that GSR to be dropping at some stage this year.
That makes sense. This monthly macro and global liquidity analysis is brought to you by the Ainslie Group, Australia's trusted choice to buy gold, silver and platinum and crypto online or in our Brisbane and Melbourne showrooms. With over 50 years of operation, we're your reliable partner in wealth management. If you're looking to buy tokenized gold or silver anywhere in the world, check out the Gold and Silver Standard for the security of real-world precious metals combined with the flexibility of blockchain. Okay. We do like to provide this additional alpha in these presentations by looking at a simple trading plan that you can take advantage of over the cycle. It's a pretty straightforward system, really, where we buy low, sell high. That's the idea. But you've seen that play out. We had this chart sort of showing up at the start. We bought back there in January of 2023. We're still holding. We've talked about that through the videos, why we're still holding through that period. When you really use these tools, they're quite powerful because our performance has just been really outstanding at the moment. 34, nearly 535% over the past 868 days. Yes, that's a long time, but annualized, that's 224%, nearly 225%. Just really outstanding for doing nothing for a couple of years. And that's the point, right? Like you bring all this together so that you have long-term conviction that you can hold over that time to take advantage of those opportunities. Yeah, really, we certainly can't complain about that. And we're arguing we're not at the end yet. So who knows what that number will be when we get that sell signal in there. Look, that's the end of our formal analysis part here. But like we do each time, I sort of want to bring it back to wrap it up with some final thoughts, some your perspective on how you think that's all going to bring it together. I asked you at the start how bullish you were. You wouldn't give me numbers. You did tell me you were very bullish. Joe, let's start with you. What's your takeaway here? Are we in for a great June? How do you think it all pulls together?
I'm not going to necessarily say it's just June. I'll say over the coming months, potentially Q3 and Q4. It's our job, I suppose, is assessing where liquidity is currently and where we think liquidity is going to be going forward. And going forward, I think with what's happening in the global economy, particularly if you're focusing purely on the US, with this big beautiful bill that comes in that needs to be financed, it's potentially going to be financed by a lot of short-term treasuries, which are quite liquidity positive, where the demand, and that's where the demand is for US debt. I really just don't see how we get a downturn in liquidity, and I'm really not worried about those recession fears or that black swan event that many market pundits seem to keep mentioning.
Yeah, they've certainly eased off their concerns, I think, from what we saw. I think my wrap up on that is along the same lines of that chart we showed before about how quickly, and the conversation we had before about how quickly it's moved from negative sentiment back to at least neutral, somewhat positive. I think there are risks on the horizon, but they are on the horizon and they're not in the here and now when we've got all this stuff we've talked about going on. So I think I probably settle in that's why I remain bullish, because over the time frame we're looking at over the next few months, there's nothing there that can really cause that unless we see another big tantrum over something tariff related or some policy related happening. But at the end of the day, that should be very short-lived because those things can be overturned quite quickly. They're not fundamental. The longer-term stuff that's fundamental will be the big concern, but I don't see that on the immediate horizon for concern. Paul, I'll leave it to you to wrap up. I know you've got some thoughts and probably something exciting to talk about as well.
Yeah, sure. Look, I agree with everything you guys just said. I personally will be watching the US dollar like a hawk from here. It's at a really interesting juncture where it is right now. I think the exciting news is within, before we meet again in a month's time, we'll be launching our first wholesale investment fund, the Ainslie Bitcoin and Bullion Fund, which is basically offering secure exposure to Bitcoin with active management of the drawdowns using precious metals. So it uses all the framework that we discuss month in, month out. And we're very excited to be launching that quite soon. So stay tuned if you want to learn more about it. Again, I stress it is for wholesale investors only. Go to ainslewealth.com or just ainslie.com.au and you can get to any of the Ainslie group through that avenue and reach out to us. We'd love to have a chat about it.
Yeah, and it is very exciting because all this work we put into the analysis, it's great to be able to bring that all together in a fund format. And I know some people will be quite excited about the prospect of that. So certainly go and check that out at ainslewealth.com or ainslie.com.au. Both will direct you there. Look, another great analysis, I think, another great deep dive. I know people really do value this. So thank you everyone for watching. Thank you, Joe. Thank you, Paul, for coming along, bringing those insights as you do each month. We'll keep churning away in the background, keep watching that. But overall, it was a very positive ending. So thank you both for your time, and we'll see you again then. Thanks.
Thanks, Chad. Thanks, everyone.
Thank you.
Thanks, everyone, for watching. We'll chat again soon.